We're diving deep into offshore drilling. You're in the right place, folks, because this is where the money is. I'm Allison Southwick, and I'm joined today by Tyler Crow. It's Thursday, so that means we're talking energy.
Oh, well, that's the reason I'm here, right?
That's the reason you're here. I mean, you can talk other stuff other than energy.
No, I can't.
You only care about energy?
Anything outside of energy, I start going, oh, it's like, you give Darth Vader kittens. He doesn't know what to do with them. It's anything outside of energy, I stay away.
That's a cute picture, Darth Vader with kittens.
It is.
Oh, I am glad you're here because we're going to talk a lot about offshore drilling. The market has kind of cooled off a little bit in the latter part of the year. Energy sector has really not done so well this year. But in the energy sector, the part that has really stunk is
offshore drilling.
Offshore drilling. So you might be wondering, as you're looking at these companies, wow, is this a buying opportunity? They've got great dividends, or is this a trend that I don't want to get into? So you're going to help us figure that out today.
I'll see what I can do.
All right, so for those of us who maybe don't follow energy as much as others, what is an offshore drilling company? What do they do?
Sure. Basically, the easiest way I like to think about an offshore drilling company is they're a rental equipment company. Think of just where you go and rent a power saw for when you're doing your weekend projects or something like that. It's the same idea. They own a bunch of really high-end advanced technology that is used for drilling offshore in deep water, shallow water, doesn't really matter. And they basically rent them out to the really big names in the world. You have your national oil companies like the Saudi Arabian Oil Company or your Exxon Mobils, your Chevrons, or basically even down to the smaller ones who are just looking to make that play out in the world.
So these are companies, like you said, it could be a foot of water, it could be thousands of feet of water. They just own the equipment and they rent it out. Why have they been hurting so badly lately?
Well, there's been a whole bunch of things, and one of the great ways to look at this is what are called the diversified companies, the companies that own the ones that can go in a foot of water, or the ones that can go in 10,000 feet of water. There's a chart that you're going to be showing right now, shows basically a stock chart for all of them. It's companies like your Seadrill, your Transocean, Diamond Offshore, Ensco, all these guys, they're down more than 30% this year.
The colors are pretty on this chart, but
yeah,
the
but that's
lines
the
are all
only
going
thing
down.
that is pretty about it at all. What's going on is there's a couple of major industry trends. It's kind of one of those things where there's a bunch of things, but the couple that actually really matter are, number one, you have these companies have just bought a whole bunch of new rigs. They bought them a couple years ago. They put in orders because they thought, there was going to be a great demand for rigs in the next few years. Problem is they bought a couple too many. So we have this oversupply in the market, especially considering that there are a lot of older rigs, that companies aren't quite ready to let go of yet. They're like, I can maybe still get a couple $100,000 per day out of this one, but even though it's 30 years old and every 20 days we have to go put it in a shipyard to get it repaired or something like that. So that's your basic idea of the supply chain. There's a lot of companies that have a lot of supply right now. Then at the same time, if anybody has seen what's going on with oil prices right now, the people that actually would rent out these rigs are saying, the high costs of offshore drilling, because it is one of the most expensive barrels of oil to actually produce, they're saying, maybe going out and drilling in the offshore regions right now is not the most attractive way to be spending our money, especially since we're going to be bringing in lower returns. So a lot of companies are kind of scaling back on their spending, get a little bit skittish. So when you have that little bit of oversupply from bringing on too many rigs and a little bit of a waning demand, you got an equation that just doesn't quite work out for these companies. And then just to add a little kind of insult to injury on this one, we've got shale drilling in the United States, and if you've seen the amount of oil that we've brought online, is one of those things where it's a supply to the market that makes offshore drilling a little less necessary.
So then, obviously, a big drop could be a buying opportunity. So people might be looking at offshore drillers more closely
Sure.
than they have in the past. What are some of the things that they should look for when evaluating? Because there are there are hundreds of companies, over 100 offshore drilling companies. There's about a dozen that you can invest in.
Yeah.
So when you're looking at these companies, what should you be looking for?
I mean, obviously, there's the basic financials that everybody else looks at, your EBITDA, your earnings, cash flow, the basic tenets of any company. But when you're looking especially at rig companies, one of the other things you need to add to that list of financial statements is what's called the fleet status report. What this is it's a report that all of these companies that are publicly traded puts out like once a month, maybe even every quarter, and then does periodical updates. It tells you what every single rig in the company is doing right now, where it is drilling, how old it is, how long its contract is, if it has another contract in place afterwards, how long that one is, and how much of all of them are worth, and things like that. And basically what you can do is use that as your guide for how these companies are going to work out. So some of the things you want to be looking for is how old are the fleets, the rigs that these companies have. If you have a bunch of really old rigs, maybe those things are going to be retired relatively
Define
soon.
really old.
20 to 30 years old.
I happen to think 20 to 30 years old is quite young.
It is
guess
young.
for a rig,
it's young on for a person. It's old for a piece of equipment that has to be out on the ocean. So, when you're looking at it that way, the other things you're looking for is, on top of how old, is how long the contracts that they have are in place. If you have a contract that is only 6 months long, then you're starting to worry. Okay, this thing's going to go off contract. But if it's 5 years and all of the entire company has a fleet that has 3 to 5 year contracts and 80 to 90% of its fleet is contracted this way, that looks great because it's a very steady source of income for many years to come. One of the metrics that they call that is the fleet utilization rate, and that's one of those important things that all the companies are going to talk about every quarter. Our fleet utilization is somewhere probably between like 70 to 90. Obviously the bigger the better. So those two things, how old are they? What kind of contract duration do they have, and how much are they actually getting per contract? Because those older rigs, because they're a little bit more limited in the technology, they aren't going to be able to attract as high of a price, and so, which obviously means lower margins. So again, high contract rates, long contract lengths, and make sure that the fleet is going to last for more than 5-10 years.
All right, so 3 important things. What do you think is most important when we're facing a down market?
In this down market, I think it depends on basically your stomach for investing. If you're looking at this as, I only want to be involved in these for 3 to 6 months, which, that's really not our thing. At the Motley Fool, we're more on that long-term sort of thing. But if you're looking on that short-term, number one, I would stay away from this industry altogether because it looks pretty rough for at least the next couple of years or so as all those new rigs start to actually get contracts, some of those older ones, stop sailing anymore, and then perhaps we'll see a little bit of uptick in demand for them. So if you're looking on that short-term horizon, stay away completely. However, if you're looking at this for someone my age or in my kind of investment thesis where I'm like, I want to buy something that I'm going to hold for decades, I'm really looking at the fleet itself. I'm not as concerned with the contracts and what the rates are today. I'm more looking at, okay, I'm going to look at the quality of the fleet, the companies that have the really new rigs, and the ones that don't have a whole bunch of old rigs. That's going to be much more important to me because 5-10 years down the road, that the asset is much more valuable than some of the other companies. So that's, I guess you could say, the most important thing I'm looking for.
So if your holding period is decades for an offshore driller, does that mean that you're also betting on the strength of the petroleum industry and oil as well? Like you're...
Yeah, you are.
You're
yes, you
really
are. And at least for me, one of the things that I've kind of reconciled with my investment thesis over the long term is as much as we are moving towards alternative energy, over the next 20 to 30 years, oil is still going to play a very, very large part of our energy mix. Just about the U.S. Energy Information Administration, the International Energy Association Agency, I can't remember. It's always those acronyms.
IEA?
Yeah, the IEA. All of the big the integrated majors, everybody is saying that between now and 2040, total oil demand is going to grow about 30 to 40%. So we're still going to need that demand. And based on that, offshore is going to be a major component of that.
All right, so like we said, there are hundreds of companies out there, about a dozen you can invest in: Transocean, Seadrill, Ensco. Which one do you like the best?
I am particularly fond of Seadrill right now, and basically for a lot of the reasons that I just talked about. Number one, it has the youngest fleet of all of those companies that we just talked about. So, 5, 10, 20 years down the road, that is going to hold much more value than somebody like a Diamond Offshore, who has an average fleet age of more than 20 years right now. At the same time, if you actually even look at their contracts right now, they have the highest contract utilization rate, and the duration of those is most robust of all the companies out there right now, to the point that they may be able to kind of weather the storm of this bad market much better than other companies. The other thing that I look at it right now is it seems like an extreme buying opportunity right now. If you look at it year to date, they're down about 38%. And with their current dividend yield, that yields about a 16% year on year. And so if you're looking at it and say, if I can pick up shares today, I'm basically guaranteed a 16% return on dividend alone, not even caring about share price appreciation. So that looks very valuable to me. And there are some worries. People might think, whoa, 16%, that dividend is completely unsustainable.
Yeah.
But according to company's management, they believe that they can hold that dividend for at least a year to 18 months. And by then, by most accounts of analysts, most other people are saying that within that 18-month period, a lot of this kind of rough market should pass. So kind of adding all those things up, it really seems to me like Seadrill is the pick to go with.
All right, well, we might as well end on a high note with the company that you are most fond of, Seadrill. All right, well, before we go, I want to remind you guys that our mission here at The Motley Fool is to help the world invest better. We do that a lot of ways, including Where the Money Is, our radio shows, our podcast. We publish articles on Fool.com, and we also offer services like Motley Fool Stock Advisor. It's our flagship service run by Tom and David Gardner. Over the decade, the recommendations in Stock Advisor have more than tripled the market's return. It's the best way to get started investing, and we have a special offer for you, our Where the Money Is listeners. Just go to wtmi.fool.com to learn more. And if that's not enough for you, you can also follow Tyler on Twitter at Tyler Crowe, Crowe.
Yeah, can't forget the E. Think like Russell Crowe.
All right, Tyler Crowe Fool. And you can also follow us at TMFWTMI. Wait, maybe it's not TMFWTMI.
Don't look at me.
Oh my gosh, I forgot our own Twitter handle.
We'll put it in the article.
Well,
Make sure everybody gets
it. Thank you. I'm a little out of sorts. I just got back on vacation today, so.
Was it good?
It was amazing.
Oh,
I rode an elevator with Billy Zane.
That is one of the weirdest but most
I know,
week.
It's really bizarre. And he was on vacation with the guy from The Sopranos who also does the tequila commercials. You're going to have to think about that a little bit to figure out who it is, but I don't know his name. But they were on vacation together.
That's pretty awesome.
And with family or friends or something. Anyway, it was bizarre, and Puerto Rico's awesome. I highly recommend it. All right. I think that's enough yapping for today, huh?
I think so.
All right, well, for Tyler Crowe, I'm Allison Southwick. Thanks for watching.